Hi and welcome. My name is Casey Boland. I'm a wealth advisor and partner with HCM Wealth Advisors. I'm joined today by Doug Johnson, who's our Senior Investment Strategist and partner with HCM Wealth Advisors, and also the one who chooses the song. So, Doug, I first thought you were going to exclude my selection of song choice, but kudos to you with the Bengals song that you included there. Welcome, everybody, to our webinar. If you'd like to ask a question, please go to the bottom of your screen and click on the Q&A, and there you'll have the opportunity to submit your question, and we'll do our very best to answer at the end of our webinar. So in our organization, we like to start off our internal meetings with a positive focus. So Doug hit the perfect song. So with that in mind, look no further for a positive focus in this past weekend, where the Bengals won a playoff game for the first time in 31 years. That date, January 6, 1991, it was the last date of victory. And let's look at some perspective here with the stock market. Where was the market back in January of 1991? Well, you can't see the exact number here on this particular chart, but the S&P 500 on January 6, 1991, heading into the weekend with the Houston Oilers, who are now the Tennessee Titans. The market, the S&P closed at 321. Fast forward 31 years after the recent Bengals weekend, and the S&P in recent days closed at 45.57. That's an annualized return of the S&P 500 over that time period of 11.2% per year. I mean, that's an incredible rate of return. The long-term average for the stock market is somewhere between 9 and 11. So during the last 31 years, when you get 11.2, that's fantastic. So we know it's been 31 years since the victory of the Bengals. But Doug, let me ask you a quick question. And when you think about the 31 years, how many years, now we're talking S&P now, not, we're not going to dig up any more about the Bengals. We'll think positive. But with the S&P 500, how many years during that span did the stock market actually return between 9 and 11% in any given year?
That's a good question. I actually know the answer because Casey and I went over this prepping for the webinar, but I think people probably think it's more than the answer actually is. So Casey, why don't you tell them what it actually is?
It's only 2. And actually, when you go back 95 plus years, you've only had 3 years in that time span where, in fact, the market even performed anywhere close to the average. So I mentioned that just because we all have experiences. And when we measure the stock market in a given year, we measure and say, hey, was it a good year or not? We often compare it to the average, when in fact, the stock market rarely performs to the stock market average. More than 95+% of the time, you're not going to get the average number. So average is not normal. So if we look at this chart a little more, let's look at the market trajectory, what actually, in fact, happened during those 31 years. We look at this chart. So the market moved in 3 distinct phases during that time frame. The first was 91 to 99, which it's hard to see on the scale of this chart, but that was an incredible bull market that then ended going into the next phase, which was the phase from 2000 to 2009. And that started with the tech bubble, with the market dropping for 3 straight years. Then you had a recovery for a couple of years, only to see the Great Recession start in late 2007 through the spring of 2009. And that was a 10-year period of time that we were glad to see end, but you really had almost no returns in that lost decade. But really from 2009 until 2022, stocks reversed course, and they've been on a tremendous strong bull run ever since. Now, I know sometimes my memory slips me, but and I think my memory wants to slip me and not think about the 2020 market. And you see that blip on the chart there. We had that pandemic-induced recession, which we saw the market drop by almost 35%. It was a matter of weeks, but it turned around very quickly and erased those losses by the end of the year. So we had great momentum after 2020 heading into 2021. Early 2021, you had the news of the vaccine development, and that really helped the market continue to have a very good year. So if we take a recap and take a quick look at 2021, the S&P had a very good year. It notched 70 new all-time highs during the year. Volatility pretty non-existent for the S&P during the course of the year. We went from an incredible amount of volatility in 2020, but in 2021, the S&P 500 barely reached a 5% correction, and you had it on two different occasions. And both of those occasions, they were short-lived, and the market bounced back very quickly. In the bond market, the Barclay Aggregate Total Bond Market Index, it's kind of like the S&P 500 of bonds. It did have a negative year in 2021. It was down slightly. Interest rates increased during the year, which works inversely to bond prices. So hence why we had the negative year with bonds. Inflation, it reached its highest level since 1982. That's certainly going to be a topic of our discussion today. The Fed went from saying that inflation is transitory to saying that inflation pressures may persist for much longer than anticipated. And when you look at the C-suite, you look at CEOs and those executives, the Conference Board survey a year ago, when you look at the results of that survey, inflation barely registered on CEOs' radar. It ranked number 22 on the list. It's rocketed now to number 2 here in 2022. And a lot of CEOs still expect more than half that inflation is going to linger into 2023 and beyond. Now, this last bullet point, NFTs, you had a non-fungible token of an ape of all things. It sold for $2.7 million. Doug, you can share the picture. I mean, you can't make heads or tails on which of these pictures is actually of the NFT that's sold for that amount. But that really gives you a perspective of a lot of the excesses that we've had in the market. NFTs basically are it's a form of a token. It's a non-interchangeable unit of data. It's stored on the blockchain. It's a form of a digital ledger. It can come in the form of photos, videos, and audio. And because each token, it's uniquely identifiable, NFTs, they differ a little bit than the blockchain currencies such as Bitcoin. I think we're going to see more and more of these things with NFT occur over time. It's a form of an asset class that you can invest in. But again, it was some of the different levels of extremes that we were seeing in 2021 last year. So moving on from the volatility aspect of it, I mentioned that with the S&P 500, volatility was fairly non-existent. Now, this slide measures how many days it's taken over time before the market has experienced a 10% correction. And you can see here on the right side of this chart, we're coming up on 400 days since we last experienced a 10% correction. And there have been several times in history when it's taken 300 to 400 plus days before experiencing a 10% correction. So that expression we've continued to hear in the last year or so of buy the dip seems to have been the common expression for the stock market. But we would expect that volatility is likely to be more prevalent in 2022. And we wouldn't be surprised to see a 10% correction in the coming months.
In Casey, one thing to point out here, this chart referenced the S&P 500. If you saw a chart of the NASDAQ or the Russell 2000, which represents small caps, they have already undergone a 10% correction. And we'll look at kind of some of the details of that here in the next few slides.
Yeah, good point. We're going to take a little bit more of a deeper dive at when you look beyond just the surface of how the indices performed. You look at a little bit more of the makeup of it, and maybe the S&P was a little bit more benign, but some of those other indices certainly did have some more volatility. So this chart dates back to 1957, and it charts every market drop of 20% or more after the stock markets hit an all-time high. So that's what that ATH stands for on the chart. And on the bottom of the page are the number of calendar days after the market peak. So on the right side, the chart is 650 plus days, which is just under 2 years. And there are 10 market lines drawn on this chart. And 7 of these 10, they haven't recovered back above that 100 level, indicating that the market didn't recover the losses or that severe drop. And more often than not, it takes years for the market to fully recover losses. And that red line on top, that's charting the path of the drop in the stock market that occurred back in 2020. So I said hiccup earlier. It seems appropriate for 2020 when you're looking at the chart on your screen, because the recovery we experienced in that year that was induced again by the pandemic, it didn't follow the typical recovery script. We saw a drop, and as quickly as it dropped, in less than 200 days, you already saw a recovery of all those prices It's certainly not your normal drop nor your normal rise. So we mentioned that 2021 was a good year in the market. So if we go on to the next slide, that the returns for some of the major indices on the left, you're going to see the S&P 500 index, it returned 23%. And the second column from the left shows, what was the largest decline of the indices during the year? And I mentioned before the S&P only dropped by about 5%. But what Doug was referencing, we're going to start to see here a bit more. You saw the NASDAQ and Russell 2000. So the Russell 2000, that's small company stocks. They dropped just over 10%. And that third column, which is the middle column there, indicates the percentage of stocks that had a positive return for the year. So the S&P had over 80% of the stocks in positive, which is pretty good. Maybe a bit more of a surprise, though. You look at the NASDAQ, Russell 2000, and they only saw around 60% of their stocks close with a positive year. Now, if we look at the fourth column, or the second from the right there, you're going to see when you look at all these cases that between 89 and 99% of all stocks at some point dropped by 10% or more during the year. Now, the real eye-opener, though, is this last column. The last column is, what was the average decline of each of the respective stocks within these indices? In the NASDAQ, the average stock declined 43% during the year. I mean, that's a huge drop. It's a very similar picture to the Russell 2000 as well. So, how do you have positive returns for the indices during this year when you have such large drops in these stocks? It's a good question. And what we're seeing is that many of the larger companies within these indices are stocks that perform better. The indices are constructed based on the size of the company. The larger the company, the larger the weighting in the index. So there are a couple thousand stocks, for example, in the NASDAQ composite. Apple's the number one company as far as size in that indice. It makes up more than 11% of the NASDAQ index. So it's good to be able to dig below the surface and see really what's happening within the actual stocks in these indices. And as we go to onto this next slide, you're going to see this a little bit more. And as you can see in recent months, many of these story stocks have stumbled. And a story stock is just referring to company shares who the values reflected expected outperformance. It's the combination maybe of some new innovation. It's been favorable press coverage. It's that type of company rather than its market value being solely based on fundamentals like assets, and you look at income components. And you've had a number of unprofitable stocks that performed well in 2020, and many of those are experiencing some severe level of pain here in the back half of 2021 heading into 2022. So, Doug, let's move on. Let's focus on the outlook of 2022. So is the Federal Reserve going to have anything to say about the performance of stocks this year?
I think they're almost certainly going to have something to say. Whether the market wants to hear what they're going to say is a different story. But I think the main theme of what's going to happen next year is how the Fed is going to handle raising rates in an inflationary environment, whether that's going to persist or whether it's going to kind of go away. But I think that how they handle that aspect of their job is going to be the number 1, 2, and 3 driver of what kind of market we see this year. So just as a quick recap, let's talk about what the Fed's mandate actually is, at least the explicit mandate. So they have a dual mandate of price stability, which is trying to control inflation, and then having full employment. You can see here that the inflation picture is much higher than it's been since any point going back to 2002, while labor conditions represented, a higher number is better. Obviously, labor conditions based on this have done a good job. So you could say, they've easily controlled one of their mandates here in the Labor Department, but inflation now is becoming a huge issue. And historically, when the Fed has tried to combat inflation, it has resulted in the Fed funds rate moving higher. Now, some could definitely argue that the Fed has a third unofficial mandate, which is monitoring the stock market and preventing significant drops in risky assets. That's not one of their explicit mandates, but you could certainly talk to a lot of people on Wall Street, and they would echo the sentiment that they're also kind of behind the scenes trying to do that. I'm not going to say either way there, but I think one of the things going forward that's going to be important is how the Fed deals with a rising rate environment if they do need to raise rates, and how stocks are going to react to that. Because just before we hopped on this call, if you looked at the close today, we had a very, very ugly close in the market, and it almost starting to feel like the market is playing a little bit of chicken with the Fed, saying, we don't think you're going to do what you say you're going to do, and if you do, we're going to throw a temper tantrum and make it so that you're going to have to reverse course. But let's start off with what HCM's 2022 base case is. So as we look at the economic outlook and what might happen in the market here, we cover a broad range of topics, and really we're going to touch on what we feel like would be winners and losers in certain sectors. Very, very hesitant to give specific numbers just because I don't think it's really relevant in this case, but let's go ahead and look at some of these points. So we believe that earnings growth can remain strong and will remain strong, even if the growth rates subside a little bit, mainly due to higher year-over-year comps. In the next chart, you'll get to see that numerically. If economic growth can remain steady, and we think it will, we think there's going to be an acceptance of life with COVID, and that whether that is reduce restrictions on vaccine mandates, testing, masking, whatever it is that would be less restrictive. And to see this in practice, you just saw in England, they just decided to basically do away with all COVID precautions. No masks, no social distancing, no work from home requirements, which you think about that a year ago, based on where we are now, just off the case counts, you would think that was almost an impossibility. But there seems to be a kind of a social shift of acceptance in dealing with living with COVID, so to speak. And if that continues, I think you'll see businesses allowed to remain open, and I think you'll see consumers maintaining spending levels from a combination of rising wages and lower unemployment levels. Now, we do think rates are going to rise on expectations of inflation and tightening Fed policy, though the pace, I think, will be measured as inflation growth moderates a little bit. We're seeing extremely high year-over-year growth rates. We mentioned the highest since 1982 in that aspect. And I don't really think that's going to continue. Again, you're going to start to see higher comps, a higher bar, so to speak, with year-over-year numbers. And I think if you begin to see that, kind of acceptance of COVID, not just only in the US, but globally, we could see the supply chain start to thaw a little bit. And that could go a long way to lowering or moderating inflation a little bit, giving the Fed a little bit more wiggle room to not have to act a little bit more aggressively than they want. And if they're not forced to act more aggressively than they want to, I think it'll give the market a little bit of time to digest this shift in policy expectations. But I do think you're going to see an increase in volatility as that takes place, much like somebody who is eating too much spicy food. You're going to get a little bit of indigestion here as the market, both equity and bond market, tries to make sense of what the Fed might be doing going forward. So we think the winners in that type of environment are similar to the ones that we thought would be winners at the beginning of last year, with maybe a little different twist. I don't know that we're going to be able to see the level of returns that we saw from maybe the beginning of the year to April in some of these asset classes, but we still think that these will be the best performers. So things like value, quality, particularly high quality, good balance sheets, high cash, good free cash flows, companies that are paying or increasing their dividends, which has obviously been a staple of the firm since it was founded. And then foreign, which I know for a lot of people is an elephant in the room. It's been a tough 15 years for foreign versus the US. But again, the same things that have been in place for foreign equities to be attractive are still there. And I think in some instances, they're even more attractive than they've been in the past. And if you look at most foreign indexes outside of maybe Asia, they are geared more towards value, specifically in Europe. So you've got more financials, more cyclicals, more industrials in there. So historically, when value outperforms growth, foreign also tends to do well. And we actually saw that at the beginning of last year, and unfortunately faded off as the year went on. But those are the asset classes that we think will be winners in this scenario. The losers, as we just saw, narrative growth, anything that is high growth or is expected to see returns way out into the future. We think the rising rate environment is going to absolutely hammer those positions. And as Casey pointed out in the last slide, the non-profitable tech index, which is a Goldman Sachs basket of stocks, is down almost 50% from its all-time high. And I'm sure that number is a little bit higher after the price action that we saw today. But we think that will be a very, very tough place to be in the market. And anything that has a significant duration on the fixed income side. And as a reminder, duration is just a fancy way to talk about the relationship in fixed income between interest rate moves and price movement. So if you have a duration of 5 in a bond or a bond portfolio, interest rates go up by 1%, the value of that bond or portfolio will go down 5%. So when rates are moving higher, owning a lot of duration in your fixed income is probably not going to be a good place to be. So as we kind of expand on these topics a little bit more, I mentioned earnings growth. So one thing we've seen a lot about, talk a lot about to clients is valuations and concerns that valuations are high. And this is the S&P 500 trailing 12-month P ratio going back 10 years. We can see this massive spike here where we got all the way up to about 35, which it was either an all-time high or very close to an all-time high. But since then, we've had valuations coming down. We've had this happen in the face of rising stock prices. So how does this happen? Well, very easily. You have earnings that are growing 65% year over year. Now, that comes from a trough of minus 22, but that kind of earnings growth can result in an environment where you have valuations that are coming down even as stock prices are coming up. Now, where are we as of today? We're right around that 5-year average on a 12-month PE, still above the 10-year average. So yes, you could say valuations are a little bit rich, but I don't think they're as rich as they were. I think they're starting to become a little bit more reasonable, especially in the spots of the market that haven't had these massive run-ups. And some of the names that we talked about earlier, the dividend space, the quality space, and the value space. So we think earnings growth is going to continue to perform well, probably not at a 65% clip, but as long as you're getting solid earnings growth, it's tough to have those really big, nasty bear markets. Now, looking at kind of a long-term view of inflation, obviously, clients have been concerned about inflation. We're concerned about inflation. But just to give a little bit of a historical perspective, even with the inflation levels that we've seen so far, we're still not in the kind of upper echelons of historical levels for inflation. So here's the COVID surge, obviously, from 0 up to close to 7% right now. We had the great moderation during the 90s, but then the last real significant period of inflation we had was back in the 70s, and that was up in the 12 and 15% areas. So I've talked to some clients who have mentioned Paul Volcker's name and talked about how he was very, very aggressive raising rates back in the 70s to fight inflation. But the level of inflation that they were going after was much, much higher. And the mandates to kind of protect stocks were much, much lower. So I don't think the Fed is going to go with such an aggressive tack because I don't think they need to quite yet. But just so everyone has kind of a relative perspective here versus long-term, we're really not in the upper echelons of inflationary pressures just yet. But one thing to point out is that, as we break down CPI year over year and compare it to equity returns, it becomes pretty evident that the higher inflation you have, the lower the S&P 500 return is. So below 1% inflation year over year, you have an annualized average gain of almost 17%. Between 1 and 4, still 9.5, which is a good number. Now we're above 4. Now you're starting to get significantly lower numbers, 1.2, and then above 9 is 0.7. So, we hear a lot of people talking about how equities are this this really bulletproof inflation hedge. And I don't know that that's quite true. I think it is true in some aspects, but not true in others. I think it shows here that as you get into higher inflation, returns for stocks drop pretty significantly there. And finally, looking at rates versus stocks and kind of how that measures up. Really, the point we want to make here is that this is the Barclays Ag ETF, and the green line represents the total return. So as you have rates moving higher, this return moves lower. Really, since the beginning of this year, we've had a pretty big decline in bonds. And then here, this blue line is basically the ETF that represents growth stocks. So you've had, since rates coming up, you've had growth stocks really take it hard on the chin. Meanwhile, you've had things like value and dividends kind of hold their own. Granted, they're starting to participate in this move lower like everything else. But in the initial phases of that, we were able to get some positive performance out of those asset classes as well. So obviously, the base case for us is probably not going to hit on the nose, just like most strategists who are giving S&P targets are not going to nail it. But what we'd like to do now is kind of give the widest range of variability we could give and start off with what we think a 2022 bear case would look like. And then we'll finish up with the 22 bull case. So for a bear case, I think what happens is you have inflation that continues to increase almost in an aggressive manner. And you're really going to force the Fed's hand to raise rates aggressively. So if you have, supply chain issues continue, if you have global COVID cases continue to peak and trough with new variants, and that exacerbates, the existing supply chain issues and increases inflation, I think that's kind of the worst case scenario that you have. And basically what happens is you have a market that can't handle the accelerated pace of rate hikes, and you get risk assets that not only reprice, but aggressively reprice. And some have made the argument that you're already seeing that aggressive repricing in some of these growth stocks that were the quote unquote darlings of the 2020 bull market. But I think if we get the scenario, they still have quite a ways to go in a bear market scenario. So what would be the winners in that category? So you'll notice duration fixed income is on there twice, and I'll explain that in a second. But we think anything that has a lot of duration, treasury bonds or assets like that would be winners. And really, we feel that way because if you look at every major bear market for the last 100 years, long-term treasury bonds have been probably the best performing asset class throughout those markets. When everything else, when all risk assets correlations go to 1 and everything's going down at the same time, long-term treasuries have held their own and actually performed very well. Then you're talking about things like defensive sectors, staples, utilities, the historical sectors in the market that don't have huge rises, don't have big falls, but are considered those defensive stocks that also happen to pay dividends as well. And cash, we seldom talk about cash. Most people don't like to hold a lot of cash just because it feels like it sits there and does nothing. But if you're in a bear market, you're in an aggressive risk repricing, cash is not a bad asset class to have in your portfolio. Now, the flip side of that is duration fixed income. So why do we have that on there twice? So I think in a bear case that resulted from aggressive rate hikes, initially the Fed would have to raise rates to battle inflation, and that those rates moving higher would really affect the duration fixed income. But at some point you would reach that critical level where they would probably go in and try to start cutting rates again to combat the lower market prices, so to speak. And in that instance, when you start getting rates going down, duration would then start to perform. So it's a little bit of a two-stage winner and loser there for duration fixed income, but wanted to provide an explanation for that. And then, in a bear case like that, I think almost all equity sectors and styles would certainly struggle. Obviously, we have the durations or the defensive sectors as winners here, but I think it's important to point out those are probably relative winners. And when we're talking about relative winners, we're talking about equities that are down 15% instead of 40. So Obviously nobody wants to be down 15, but when you're looking at the alternative being down 40, that's what we kind of talk about when we're discussing relative winners, so to speak. But bear markets are very hard to navigate, especially with all correlations pretty much going to one, and asset classes, foreign, U.S., whatever you want to look at, usually move in lockstep during the worst of those periods. So we talked a little bit about the supply chain issues, and we can see that in some places it may be getting better, excuse me, but unfortunately in some places it's getting a little worse. Here we have the container ships at the LA and Long Beach ports have hit record levels. On January 6th, you have almost 105 ships now waiting in line to just come in to port and unload their items. So that is a significant number of ships waiting to just unload goods. And as they're sitting there waiting, those are goods and services that can't get out in the supply chain. And it really just snowballs when somebody needs a part that they can't get, and then that person needs a part that they can't get. And that snowball effect, I think, has had a lot to do with the inflationary pressures that we've seen, simply because people are having to pay up for a limited number of goods and services that are out there right now. So we really would like to see this number start to move down a little bit with the increase in Omicron cases that we've seen, and the kind of restricted actions that we've seen in China specifically. Unfortunately, I don't know that this is going to get a whole lot better, but this is one thing to certainly pay attention to if you're concerned for the bear case. So another aspect of hedging inflation, I think, is talking about gold. Hey, Casey, I'm going to ask you to take this slide if you would, so I can get a little drink of water here.
No problem. So when we take a look at gold and the relationship to inflation over time, I think oftentimes, people feel there's a real strong correlation that as you have high inflation, that gold does a great job of being a hedge against rising inflation. And certainly you did see a period of time in the late 70s and early 80s when gold did perform well, and we did have a period of high inflation. But outside of those periods, historically, oftentimes this is kind of what the chart tends to look like. And you can see back in 2020, when you had the consumer price really dive down. So that was the beginning of the pandemic when everything was shut down. And then you saw the real strong surge over time as quickly things were starting to become back online. Consumers had more dollars in hand and looking to spend. So that really pushed up inflation pressures up to the recent mark of 7%. But you can see gold moved a little bit more on the both the anticipation possibly of inflation, maybe a little bit more of a defensive posture because of what was happening in the market back in early 2000. But, since that point in time, after you've had some real sustained moves up inflation pressures, gold has been on a slow trajectory down when you look at the last 18 months. And so the argument that gold is a great hedge against inflation, unfortunately, from what we've seen over the years, has just not been the case.
Yeah. And then, when we talk about the Fed specifically starting to taper their asset purchase program, the possibility of raising rates, and then lastly, we've seen the introduction of talking about actually, rolling down the balance sheet, where they're taking the assets that they have already on there and starting to put them back to the market and sell them. You can see the setup for a little bit of cause of concern here. So this purple line is the actual value of the Fed's balance sheet. So, not as close a relationship as we've gone through here, but things to notice are when you've had this level off and start to drop, at least in the leveling off phase here, the gain, was significant up to a point, and then you started to have a little bit of a drop off. We really had a sideways move, and then obviously when the Fed really put the foot on the gas, you've seen almost a perfect correlation to where the market is. So if the Fed does decide to, they've already begun the tapering process, but if they begin the process of actually selling off the balance sheet, how that relationship is going to look versus the value of the S&P 500, I think is going to be an important thing to pay attention to. Excuse me. So now you get to the bull case. So I think in the bull case, you have earnings growth remain strong, even if growth subsides. So it's basically the same bullet point that we have from the base case. Really, the differences are now you get global COVID cases that are decreasing significantly. And this, I think, will ease supply chain issues and it will let the air out of inflation a little bit. All of a sudden, the Fed now has room to significantly reduce the pace of rate hikes and possibly put a ceiling on bond rates. Now, would they still raise rates in an environment like this? It's yet to be seen, but I think if inflation were to come down quite a bit, I think they would be much more measured in the pace of inflation. I often joke that Jerome Powell goes to bed every night and prays that the CPI numbers are going to come down. But I don't think he wants to raise rates. I think he understands what's at stake in terms of the market if they have to go in there and start to raise, but they have an explicit mandate to control inflation. So their back is really against the wall right now. So what are the winners be in that environment? I think mid and small cap would certainly do well since they're extremely economically sensitive. I think things like emerging markets would do well with a recovery, and then things like high yield bonds on the fixed income side. What would be the losers there? I think your defensive sectors would struggle. Again, this is relatively struggle, so you could see a positive return in those sectors, but I don't think it's going to be as good as what you would see maybe in some of the cyclical or more risky sectors. I think short duration bonds would struggle simply because yields would be low. If rates were actually to come down a little bit, that lack of duration in those bonds would not offer the opportunity for any total return aspect. And then obviously cash in that situation would just be, quote unquote, dead money, no return there. And I think it would be an opportunity cost, essentially to what you would see for more risky assets. So that's kind of the bull case. And as we look at rates or inflation versus yields, something has to give you. And historically, the bond market has been pretty accurate on being able to forecast the economic situation going forward. Now, some of the discrepancy with this could be that the Fed has involved themselves so much that it's distorted this relationship. But if we look at this scatter plot here and you see the fit, we're down here with these red dots. Right now we're in this big one. So historically, when you've seen yields, or when you've seen inflation levels this high, yields have been way up here. And right now they're just not. So one of two things is going to happen here. Either the bond market has this right and inflation is going to come back to earth in a significant way, and it's going to give the Fed some wiggle room, or the bond market is going to have it wrong and yields are simply way too low and they're going to go much higher. Now, Casey and I were kind of talking as we were going through these that you could probably interpret this as a bull or a bear scenario. But when we think about the bond market and its historical accuracy in being able to predict the economic environment, I think this leans just a little bit more to the bull side, if the most to, I think, the base case. And then again, another kind of Fed versus S&P level. If the Fed are able to keep the Fed funds rate kind of pinned to the floor, so to speak, you can see every instance where this line has been low, stocks have gone up. Specifically, since you've seen this big time recovery, massive drop in rates. And even when they started to raise rates initially, you still got a little bit or a pretty good rally here up until the point where it reached kind of a critical mass. And then they said, all right, enough's enough. We had the last significant, correction outside of the COVID area. And then we've had, here were two kind of back-to-back 15% moves during the first rate hike. So the moral of the story is in this environment that we've seen, when rates are low, stocks do well. And when rates start to rise, it can become an issue for the market and how they look, in terms of what assets are going to do well in that environment. Now, I just had a quick question come in. I believe it was about the last slide, so I want to try to address that So the data points on the bond yields versus inflation. So these are just the historical data points. It doesn't tell how far back this goes. It looks like there's quite a few data points on here, but basically it's the bottom part is going to be core U.S. inflation levels. And then this part is going to be what the 10-year U.S. bond yield is going to be. So I know this goes back to at least the 70s because you've got yield numbers that are way up here. And then you have corresponding inflation levels that are way up here as well. So what we can see is the cluster of those relationships has fallen on this line where you've got higher inflation, higher yields, but the relationships really become strong at the lower levels. And I think the most important point to this is simply that right now inflation numbers are high and yields are low, and that's not historically the relationship that we've seen. So hopefully that clarifies that a little bit. If not, you can certainly follow up with your advisor afterwards, and we'd be happy to discuss that a little bit further. So to wrap this up, what is our current positioning right now as we kind of mull over all these cases? So we're still slightly overweight equities versus fixed income. Obviously, there's, we would be remiss to not, point out that there's certainly been some deterioration in the market internals, specifically on the equity side, that could lead to some portfolio de-risking at some point, either through an absolute equity cut or repositioning within the equity sleeve to become a little bit more defensive. But for the time being, we're still slightly overweight equities. We have a small preference to value, quality, and dividends, which is what we mentioned in our base case, and that could certainly increase as we move forward. We're currently underweight foreign. And when I say underweight foreign versus the benchmark that we use internally, I know for some people, they see that and they think, it's in fact overweight foreign because it's more than most people would expect to own. But we always run everything based on our benchmark. So from that perspective, we are underweight foreign, but we see relative performance improving there. And we could look to increase that allocation a little bit as we move forward. We're certainly keeping an eye on small cap and high growth names as those internals have weakened significantly. And they could be reaching kind of that critical point where it makes sense to look to possibly adjust those positions in the portfolio. And then on the fixed income side, we remain diversified across our fixed income holdings. The beginning of last year, we made a point to really have a good mix of products in fixed income that could generate income, that could protect against equity volatility, and then could also protect against a rising rate environment. So we've added things like global macro, some inflation strategies in there, along with the core holdings that we're always going to own in there. And while, on an absolute basis, fixed income performance last year, not many people were excited about a number that's pretty much on the baseline of slightly positive to slightly negative. It certainly, outperformed simply owning the index on a relative basis. So lastly, talking about diversification a little bit, because one topic that's come up over the past 2 years has been this idea of S&P envy. Everyone looks at the S&P 500 and they see it performing really well, and they think, why am I owning any other asset classes? Because it only makes sense to own U.S. stocks, and it only makes sense to own the S&P. Well, if you look back 20 years at a diversified portfolio versus just owning the S&P, I think what you'll find is pretty interesting. So starting with 2000 to 2002, the S&P fell by 40% in that time frame. Diversified portfolio, which in this case is basically a 60-40 blend of equities and fixed income, was down 15%. So from a client's perspective, what are they going to say then? Well, I lost money. And the reality is that most people in a bear market like that, they're going to lose money. But on a relative basis, this was a very significant outperformance versus the market. Now, as we move through the recovery, performance was pretty similar, and clients happy. Hey, diversification worked. We love it. Now we move to 2008. We have another bear market. Again, lost money, but the diversified portfolio, again, on a relative basis, performed well. Now you have the 2009 to 2019 period where the S&P really outperformed that diversified portfolio. You didn't make as much money. Same thing to 2020, 2021. big outperformance. I didn't make as much money. But look where we are in terms of a total return then. You ended up in the exact same spot between both portfolios. And in this one, you experienced a lot less heartache and a lot less volatility. So the takeaway here is that having diversification is really important when you see these big market drawdowns. And even if you maintain that diversification through the recovery, you're still going to be in a good spot because it's much easier to recover from a lower level of loss than it is from a massive loss that we see in some of the bear markets. So just a little bit of perspective on diversification. I think we came across this chart and we think it did a really good job of relaying that message. And we wanted to relay that to clients. So I know we're right about time here. So Casey, any questions that you've seen come across?
Not yet, Doug, but one last point I do want to make sure that I make a point of, and that is if you are taking required minimum distributions, meaning that you're age 72 or older, or that is coming in the near future for you, the calculation starting this year in 2022 and moving forward has changed. It's changed in a good way. It means that life expectancies are now longer, which means on the calculation, the amount that you are going to be required to take will be a little bit less than would have been expected in the past. So little good news to pass on in 2022 here going forward for IRA accounts. Doug, a question did just pop up.
Okay.
So in thinking about the base case, bull case, bear case, do you have a leaning, your guys' case obviously is the base case, but are you leaning one way or the other toward the bull or the bear?
So it's a really good question. One that I probably don't have a great answer to. I think what you're going to see is a very volatile narrative in terms of where those things are going. I honestly think the bear and the bull case have a pretty equal amount of opportunity to come to fruition, but I think it's probably a little bit more in the tails where the probabilities of those are not very high. Whereas I think a bulk of the scenario analysis that you're going to see is going to be something around the base case. I think what we might see is, again, we're starting to see the market play a little bit of chicken with the Fed. And, in the past, we've seen the Fed kind of acquiescing to, I guess, larger market drawdowns, so to speak. But I think the Fed is really up against the wall here. And I think they're going to have to raise rates in some capacity if inflation stays here. So my guess would be that we see a pattern where rates move higher. There's some volatility there as the market digests that. But if inflation can come back down at that point, I think that gives the Fed a little bit more wiggle room. I think the market sees that as a good thing and could take that in stride. And we could end the year with some positive returns for the equity market. But, one of the things that I always try to tell clients, and I think it's important to realize, is that it's much easier to react to the future than to predict it. And I think you're going to have to be able to interpret kind of what's going on this year as that data comes in, maybe more than years past. And I know we spend a lot of time doing that, and we certainly make sure that we're not in the business of trying to predict these outcomes, more or less trying to lay them out and then understanding where we are and what we need to do to act accordingly. So that's kind of where we are with that. Then we did actually have one more question come through that we can get to real quick. It is, does it make sense to own crypto in my portfolio? So this is a question that we've been getting a lot. And I think that, the way to approach this is, I think you need to ask yourself as an investor, why are you looking to own crypto in your portfolio? And for most people, I think if they're being honest with themselves, it's simply the fact that it's gone up a lot. The other thing to remember is, I think a lot of the massive gains that we've seen in crypto are gone. The opportunity to buy Bitcoin at $5 and have it go to 40,000, it doesn't exist anymore. So when you're looking at, I think Bitcoin right now is trading around, 40,000. I think is the last time I saw it, maybe give or take a little bit. 40,000 to 80,000, that's 100% gain in that asset class. And those sound like huge numbers, but that's no different from a stock going from $5 to $10 or from 10 to 20. So I think people have been enamored with the crypto space because the early investors and some of these kind of side projects that got a lot of hot money have shown these massive returns that I don't think people are going to have the opportunity to get going forward. So if you're looking to add it to your portfolio simply because you're chasing those gains, I think you're going to be disappointed. But if you have a thesis on why you want to add it in your portfolio and it has something to do with, inflation or money supply or something along those lines, then yes, I think it could make sense to own a little bit of it. But I really think that investors need to be honest with themselves. Are they buying it for speculative reasons? Are they buying it for a specific reason in their portfolio? And depending on which answer you have, I think that changes how you own it and what you own it in terms of percentage of your total portfolio. So that's kind of the best answer that I can give for that. But I would also point out that in this kind of high growth sell-off, we've seen a lot of these, what I'll call fringe crypto tokens really, participate on the downside with that as well. So certainly, not saying to swear it off, but certainly proceed with caution. So Casey, I think that's it. If you want to take us out.
Sure. We appreciate the trust and confidence that you place in HCM. So thank you very much. That is something that we do not take lightly. If we can be of help to you, a friend or family member, we'd be honored to do so. Please reach out to us and be in contact. Thank you very much.